Welcome to a live wire video. My name's Matthew Kidman, and today we're talking about market dip. It's been a bugger of a year, 2018, and is it a dip or is it a lot worse? Well, to discuss it with me, I've got two new faces today, Tobias Yeo from Wilson Asset Management and Arden Jennings from Ausbil. Welcome, gentlemen. Start with you, Arden. Is this a dip and do we buy it, or is it something a lot worse that we run for the hills?
Yeah, sure. So if I think about our portfolio changes over the last 2 months, there hasn't been material changes. But if I think back over 2018, we have been taking risk out of the portfolio. So things that we've been doing is that we've been really focusing on liquidity and trying to improve liquidity within the portfolio. So we want to try and avoid lobster traps. Easy to get in, hard to get out. Yep. Been reducing high PE names. We've maintained elevated levels of cash to take advantage of opportunities as they come up. And we also exited the project-based contractors just to reduce risk in the portfolio. And
so it sounds it's not quite a dip, it's something you're prepared over the next year or so. So we might have some more choppy waters ahead?
Potentially. We don't know, right? But we want to be prepared to have a portfolio that can weather both the downside and hopefully capture some of the upside.
Okay. Tobias, let's throw the same question at you. A dip or an avocado dip?
So we think overall pretty bearish. We think the heightened level of volatility will continue. In the short term, we've taken the opportunity to top up on some high quality and liquid names, such as the waste management company Cleanaway and Novated leasing company Smart Group. At the same time, we've reduced exposure to the consumer discretionary space due to the impact from the housing and sort of the volatile consumer sentiment.
Okay, good one to lead into the next question. What kind of things are you looking for, whether they be macro or micro, that determine whether it's a dip or it's a buying opportunity for the market as a whole?
So we keep an eye out on all the macro data, both domestically and internationally, as well as the health and valuation of different industries around the world. But ultimately, we are bottom-up stock pickers, so we are trying to find undervalued growth companies with catalysts to re-rate the share price.
So the companies you talk to are going to formulate your portfolio. They're telling you what's out there.
Well, retail is pretty volatile currently. So that's one of the reasons why we reduced the position in some of our retail names. And housing's definitely haven't had an impact on some of the companies we've seen.
How about you, Arden? Is it what the Fed's saying in the US? It's what the company's saying to you? What's that one or two indicators that'll determine whether time to buy again, time to be cautious or stay cautious?
Yeah, probably a little bit similar to Tobias, but we do take into account the top down. That sort of helps us set the strategic biases of the portfolio, but that's roughly about 10% of the process. Really, we're focusing on fundamental bottom-up stock picking. So ultimately, we're looking for key earnings drivers of business. We really want to understand how they tick, how they generate revenue. Cash flow is important, valuation is important, balance sheets as well, but fundamentally, we want to understand key earnings drivers to identify upgrades and downgrades, so bottom-up fundamental analysis.
Okay, so it'll be interesting when we get to February and see the results, but you outlined before you're playing defence rather than attack at the moment. The portfolio's changed. So sector-wise, what fits that flavour, and where do you want to be?
Yeah, I would say we're still underweight bond proxies, so we're not going super defensive. We have lifted the cash, we've got a bit of gold. We still want to maintain a good rump of the portfolio in those alpha generating names, but equally we want to have some ballast in the portfolio. So perhaps they're not considered defensive companies, but they've definitely got reliable earning streams that we can count on, that can raise prices through the cycle.
Tobias, you're giving up on the consumer. You've made that clear. Where have you run to? If you've got to be long, where do you want to be in this environment?
So two areas. Firstly, some of the mining services companies with strong fundamentals. So Seven Group, Emeco, to name a few.
Both been hammered recently.
Yes, so both been re-rated. At the same time, a lot of the US dollar earners, so they benefit from a lower Aussie dollar. So the IPH of the world, main pharma.
Okay. And Arden, what about you? You take us to a couple of stock names?
Yeah, probably back on reliable earnings streams. So ServiceStream is a good example. It got smacked down 17% in the month of October, despite management providing a good update at the AGM. The NBN has a lot to roll out there, so we continue to like that. Or something like Citadel, right? It's got long-dated contracts with government, information management software for complex environments. So locked-in revenue, that's a type of business that we're looking for in this current environment.
Okay, let's get a bit excited. What's going to turn your view where you get more bullish and and a little bit more aggressive towards the market?
Yeah, look,
What's the key indicator?
Look, I think we've just got to assess it as it comes. You know, we've got OPEC coming up. We've got the FOMC, which will be critical in late December to see whether, how dovish they come out. And obviously trade wars are very prominent at the moment. So
A lot of big picture stuff in there. And then you roll into reporting season when we get
that's
there.
right. Ultimately, like I said, we're bottom-up fundamental investors. We do take that top-down into account. But it's a rolling beast. So play it as it comes.
Tobias, what's going to give you the green light where you get back on the horse and start galloping along?
So for us, it's the trade war, the visibility on the trade war, as well as the interest rates in the US.
Okay, they're the two key ones. They're young, they're ambitious, but they're awfully cautious at the moment.